But now, with uproar here and around the world about how little tax large multinationals are paying, Michael Robinson presents Tax Avoidance, the hidden cost.
Meet a man with the dubious honour of having one of the UK's biggest personal tax bills. What did you pay last year in personal tax?
30-40 million pounds, something like that, in personal taxation.
That's an awful lot of money.
Yes, it is, but it's, if you make the amount of money that I made, then it's kind of a fair cop.
David Harding founded the hedge fund Winton Capital Management in 1997. It now manages $25 billion worth of investments for clients around the world. Last year, Winton Capital paid £62 million in British corporation tax on the fees it earned. And when you sign your very big cheque for your very large personal tax and your huge cheques for what your firm is contributing, does it give you a feel good?
I don't think signing the cheques makes me feel good. Signing cheques usually evinces a wince of pain, actually, but the overall knowledge that we've paid lots of tax is part of my strategy for feeling, good about myself. Goodish. As good as a hedge fund manager can ever feel.
David Harding has a choice. Plenty of tax planners have approached him over the years, offering ways he could cut his own and his corporate tax bills. But for personal, professional and social reasons, he prefers to pay his dues.
I would say that we have made enough money to sort of have the luxury of not really having to worry about tax minimisation.
But you can afford to pay it?
Yes, exactly.
But few wealthy individuals or profitable companies seem to share that attitude. And this programme is about what happens when large multinational companies make the choice to avoid their taxes and what governments might do to stop them. Only the little people pay taxes, the late American billionaire Leona Helmsley said. The same could be said of the corporate world, where large multinationals use their global operations to cut the tax they pay in ways most smaller companies cannot. While David Harding's Winton Capital paid an effective tax rate of 26% on its profits, many large multinationals pay less than 5%. It's called tax avoidance, and it's perfectly legal. But in an age of austerity, avoiding corporate taxes has become highly controversial. When MPs learned in November that Google, Amazon and Starbucks were paying hardly any UK tax, political patience ran out.
So you're minimising your tax even though it's unfair to British taxpayers?
It's not unfair to British taxpayers. We pay all the tax you require us to pay in the UK. We paid £6 million of tax last year.
We're not accusing you of being illegal, we're accusing you of being immoral.
The Prime Minister has promised to put corporate tax avoidance high on the agenda when he hosts a G8 meeting of world leaders in Northern Ireland this summer.
There are some forms of tax avoidance that have become so aggressive that actually I think there are moral questions that we have to answer about whether we want to encourage or allow that sort of behaviour.
But will such appeals to morality be heard in corporate boardrooms? One former corporate tax lawyer says no.
I don't spend a lot of time brooding about the moral obligations of corporations. I don't blame, the maggots that eat the spoiled meat for doing so. I say let's build a proper refrigerator in the first place.
Hearing will come to order.
After 30 years as a tax lawyer advising major US multinational companies on how to cut their tax bills, Edward Kleinbard switched sides and became Chief of Staff of the US Congress's Joint Committee on Taxation. Now a leading academic, he argues that the international system for taxing large companies has effectively broken down. His evidence? A vast pile of corporate cash earned outside the United States by its leading multinationals.
We know that U.S. firms collectively have reported something on the order of $1.7 trillion of low-tax overseas income and are adding to that at the rate of a couple of $100 billion a year.
$1.7 trillion is a staggering amount of money. It's enough to buy every single home in London. This money was earned in countries with corporate tax rates of around 30%. But Edward Kleinbard says nothing like that amount of tax was paid.
We know individual firms with tax rates in the single digits. Right now, we have a world in which Microsoft reports a 4% effective tax rate on its non-U.S. income. That's not a tax rate that is consistent with any country in which Microsoft does significant business anywhere in the world. And what follows is that income that formerly belonged to the UK, formerly belonged to France, formerly belonged to Germany, that income has been stripped out, turned into stateless income, which in turn has sailed the seven seas until it found this happy home in a tropical paradise like the Cayman Islands or Bermuda.
In a statement, Microsoft told the BBC,
Microsoft operates a global business that requires us to operate in international markets. In conducting our business at home and abroad, we abide by U.S. and international tax laws.
That's a line you'll hear repeated by a host of multinationals. The low tax rates paid by American multinationals can be calculated because of a quirk of U.S. tax law. But Edward Kleinbard says it's not just American firms who are avoiding tax.
It applies absolutely with equal vigor to UK multinationals, to Dutch multinationals, and so on. Other countries have exactly the same results. They're just not as visible to the public, but exactly the same phenomenon is happening.
With non-American multinationals, it's much harder to see how much tax they're managing to avoid. But there's a powerful clue in the record amounts of cash many now have on their balance sheets. As with the $1.7 trillion American corporate cash pile, this money is looking for something to invest in. And in this, leading economist John Kay believes tax avoidance gives multinationals an additional competitive advantage. For example, in helping them expand their operations by taking over nationally owned companies, which are likely to be paying far more corporate tax.
The simplest observation is that if large companies pay a lower effective rate of corporation tax than small companies, and that is simply true, that gives a general competitive advantage to large companies over small. Put simply, different companies taking over the same, let us say, British business, they will all have the same potential earnings stream from it. But if one can pay a lower tax rate on the effective profits which the firm it's acquiring generates, then that gives an advantage to the company that has the tax technology over the company that doesn't.
Having this tax advantage, that sort of turbocharges the deal.
I think that's exactly right. And every time it happens, the tax base here shrinks a little.
A party to launch a book, The Great Tax Robbery, written by a former British tax inspector turned journalist, Richard Brooks.
So without further ado, I'd like to raise a glass, at least if I had one, to Richard and to the book.
Richard Brooks now writes on tax for the magazine Private Eye. He says the risk to the UK's tax base from tax-avoiding multinationals expanding in Britain is clear, because it's already happened. When famous brands like Boots, Cadbury's or Walker's Crisps were bought by multinational operations, the public may not have noticed much difference. But the British tax collector did. Why? Because of what's called profit shifting, where multinationals find ways to shift their profits to lower tax jurisdictions. Richard Brooks says the 1990 takeover of Walker's Crisps by the American PepsiCo Group is a classic case.
Well, with Walker's Crisps, they moved the ownership of everything, the potatoes, the crisps, and the brand name, to Switzerland, and what was left in the UK was a factory making crisps on behalf of that Swiss company.
And what happened to the amount of tax the Walker's company paid?
Well, if you are a company not making things in your own right, but doing them for somebody else, you take much less commercial risk and you're entitled to much less profit. So the profits of the British company fell drastically. And following on from that, the tax bill was decimated.
Echoing Microsoft, PepsiCo told us it pays all the tax required under UK law. So is there a pattern here that when British companies get taken over by foreign multinationals, that tax bills in Britain tend to fall?
Yeah, in every case I've looked at, it happens. I can't think of a case where it hasn't.
And is it significant, the tax loss?
Yeah, in many cases it's just wiped out.
Such losses may previously have passed unnoticed, but now the tax multinationals pay in Britain is firmly in the spotlight. Earlier this month it was the turn of RWE Npower, part of a giant German-based energy group, to appear before MPs.
Anybody watching these proceedings will be absolutely shocked that you're willing to stand up and say that we deserve not to pay tax. If I said that, I get crucified.
I think there's an informed debate that needs to be had, which says that there is general accounting rules.
At the Commons Select Committee on Energy and Climate Change, the company's chief executive Paul Massara struggled to convince MP John Robertson that the British part of his multinational was justified in paying far less tax than other UK energy suppliers.
I can honestly say I'm glad I don't get my energy from you. If I did, I'd be switching as soon as I left this room.
Questions about the finances of utilities and how much tax they pay may be new to MPs, but former banker Martin Blakelock has dealt with such issues for decades, advising on the private financing of a host of public infrastructure projects. He's now looking at what happens to corporate taxes when British utility companies are bought by foreign investors.
It's very difficult to find the financial information on many of these companies because often they are domiciled outside the UK and it's difficult to get hold of the information.
Martin Blakelock has found what he says is a remarkable contrast between a company called National Grid, which provides the pipes to get gas to our homes, and Wales and West Utilities, which used to be part of National Grid but was sold off in 2005. Both companies provide similar services, but Martin Blakelock says when it comes to corporation tax, they look very different. Because while National Grid has paid almost £1 billion in corporation tax since 2005, Wales and West Utilities has paid nothing at all. One reason, he says, is that the foreign investors who bought Wales and West chose to finance the company in part through what are called shareholder loans.
With a loan, you pay interest on the loan. Interest is a cost which is allowable pre-tax. In other words, the company can put that interest charge as a cost when it is calculating its profit, which is liable to tax.
So it takes the interest it pays on those loans and deducts it from its profits.
Yes.
And it's on the smaller profit that, if there is any, it will pay tax.
Correct. Interestingly, in the first few years, from about 2006 through to 2010, these shareholder loans had an interest rate of 21% per annum.
How does that compare to interest rates in the market at that time?
A normal interest rate for something would be between 5 and 7%.
5 and 7 in the market?
Yes.
21%?
Correct.
What's the effect of that?
The effect of that is to put the interest cost up very high, so it reduces the overall profit which is liable to tax. In other words, it reduces the tax bill.
But if a shareholder loan could save a company tax, it's good for the shareholders.
You're quite right. There is nothing illegal about this at all. But if you are seen to be structuring your finances in such a way that you are not perhaps paying a reasonable amount of tax for the underlying business that you're undertaking, then I don't think it's very good from a PR point of view.
But when it comes to financial questions, public relations don't seem of much concern to Wales and West Utilities, as I found when I called their press office. It's the most extraordinary thing. I've just come off the phone with Wales and West Utilities, and I phoned up and said, "Want to talk to someone about these loans, please?" And they said, "Fine, OK, leave it with us." And 5 minutes, maybe 10 minutes later, I get a call and they say, "No comment." But I said, "I haven't asked you a question yet. I've said I want to talk about these loans." And they said, "Well, the company's position is no comment." Subsequent emails produced nothing more. In fact, Wales and West has proved so profitable for investors that the energy regulator Ofgem recently clawed back cash on behalf of customers. But with commercial multinationals using intercompany debts to reduce their taxable British profits, there is no regulator, so they mostly get to keep the benefits. Former Tax Inspector Richard Brooks says using debt to reduce taxable profits in this way is commonplace and likely to be repeated as cash-rich multinationals now look to expand their operations.
This is a standard technique, and in some ways it's legitimate because independent businesses do borrow money to fund their operations. The trouble is that what we're seeing increasingly is that companies that are taken over are being pumped full of far more debt than they would have done if they'd been operating independently, and certainly far more than they did have before they were taken over.
So what we've seen with Wales and West, that's not just restricted to utilities?
No, it's certainly not restricted to utilities.
When it comes to legal avoidance we've been looking at, what do you think the government's losing?
Well, I think we're talking about at least £10 billion per year in tax loss. It's more than the international aid budget. It's around a third of the entire education budget. It's a very large chunk, probably half of what the health service is being asked to save in this age of austerity. So this is a major economic factor.
The Treasury calls the amount lost to tax avoidance significant. It puts the figure closer to $7 billion a year. But whatever the number, in this new age of cuts and austerity, politicians are under pressure to reduce it. The Treasury Minister responsible for taxation is David Gauke.
Of course, there is rightly a public appetite to ensure that everybody fulfills their responsibilities. Because we're borrowing a lot of money, because it's a difficult time for everybody, we're having to make some very difficult decisions when it comes to benefits and taxes and what have you. It's really important that we have a tax system that is fair, that ensures everybody pays the tax that's due under the law.
Do you reckon it is now for multinational companies?
If we're looking at multinationals specifically, where there are multinationals that do engage in that sort of behaviour, then I think there is something wrong, and I think I'd apply the test to taxpayers across the board. Is behaviour contrived, artificial, against what Parliament and other national institutions are determining to do? If they're behaving in that way, then I think that is wrong. Now, the reality is that is an international problem. The UK is not unique in that, and we want to ensure that the international tax architecture, which has largely been in place since the 1920s, is brought up to date to ensure they reflect the modern reality.
Tax avoidance by multinationals is almost by definition an international problem. To shift profits to low-tax zones, corporate tax planners have to thread their way through a maze of national tax laws and international tax treaties. As in so many other areas, Google has been a pioneer in this special skill. And far from being defensive about how little tax his company pays around the world, Google's executive chairman Eric Schmidt says he's very proud of Google's tax structures. And just in case anyone was in any doubt, he told the World at One this week,
I think the most important thing to say about our taxes is that we fully comply with the law, and will obviously, should the law change, we'll comply with that as well.
Google does generate tax for governments through the income taxes its employees pay and the VAT consumers pay on its sales. But with tax on Google's corporate profits, it's another story, and governments outside the US are reckoned to have ended up with less than 3%. The reason? Google has located the non-US rights to its brand, technology and know-how in Bermuda, where the corporate tax rate is 0. And Google Bermuda charges the rest of the group license fees for its use, and it's those fees which reduce Google's profits around the world. But for Google's tax planners, getting those fees to Bermuda is by no means straightforward. Take Britain. In 2011, Google made nearly £400 million worth of sales. The British corporate tax rate was 26%, but Google paid just £6 million in British corporate tax. That's because Google's sales in Britain are booked at Google's European headquarters across the Irish Sea in Dublin. In Ireland, Google collects revenue from around the world outside the US. In 2011, sales totaled over €12 billion. But despite this huge cash flow, Ireland ended up with just €25 million in corporate taxes. Because the majority of Google's profit on its non-US sales had already headed off to the next stop on its escape route to Bermuda, this time across the North Sea to the Netherlands.
This place is the financial district at the south of Amsterdam. So this is where you will find some headquarters of large banks and large corporations.
A little bit like London's Canary Wharf, it looks to me.
Yes, it's a little bit like that, yes. It's a relatively new centre with a lot of shiny buildings, it's true.
As a campaigner against multinational tax avoidance, Francis Vezich has investigated how multinational companies use the Netherlands as a conduit for profit shifting. He says Google does it through a company located on the 15th floor of one of the shiny office buildings, Google Netherlands Holdings BV.
The last figures available are from 2011, and in that year about €7 billion passed through the company.
€7 billion. Does it have a lot of workers?
No, it doesn't. It has no employees.
So what is the point of that company?
The purpose of that company is actually to make sure that those fees can pass from an Irish company where they are collected via this Dutch conduit to Bermuda, where the income flow will not be taxed.
But why does it have to come through a company here with no employees?
Well, it comes through a company here because if Google would make a direct payment from Ireland to Bermuda, then Ireland would charge a 20% withholding tax.
So from Google's point of view, this is a fantastic company. I mean, this saves Google what? Saves it a lot of tax? Saves it the 20% tax in Ireland?
Actually, it's more. Google uses this Dutch conduit to make sure that the license fees end up in Bermuda without any additional charges on the way.
Francis Vezich estimates that their Dutch conduit saved Google around €1.8 billion in tax in 2011 alone. So obviously this is hugely valuable to Google. What does the Netherlands get out of it?
Well, actually not that much, because €7 billion passes through, but that just passes through. There's only a very small margin that's being booked here as profits, and that is being taxed by the Netherlands, and the Netherlands gets €2 to €3 million of taxes on that.
2 to 3 million?
Yes, that's right.
And Google is saving 1.8 billion?
That's entirely correct.
That seems unbelievable.
Yes, actually many people think that the Netherlands makes a lot of money by offering this type of structures or by facilitating them. But in case of this structure, it's really not true.
Google does make plenty of money from its non-US operations. That's evident from the company's corporate cash pile in Bermuda, now approaching $50 billion.
This is the newsroom of the Volkskrant, and right here is where I did most of my research.
Okay, piles of paper. At one of the Netherlands' leading newspapers, journalist Sibren Koistra set out to discover how many of the world's top 100 companies are following Google's lead and using Dutch conduits to shift profits and avoid taxes. It took 2 months and involved analysing the accounts of over 1,000 conduit companies set up in the Netherlands by large multinationals. Of the 100 biggest companies in the world, how many have got these conduit companies here in the Netherlands?
Well, 91 are present here in the Netherlands.
91 out of 100?
Out of 100. And 77 of them, we can prove, have holdings here aimed for tax purposes, for lowering the tax burden. It's Google, it's Apple, it's Starbucks, as you know, but it's also all the major oil companies, all the major tech companies, all the major pharmaceutical companies. Amongst the 100 companies that we looked at, there were 9 English companies, and all 9 of them were avoiding taxes in the Netherlands.
PepsiCo, who bought once British Walker's crisps, are on Sibren Koistra's list, as are Kraft Foods, which took over Cadbury's in 2010, alongside multinationals from Britain, Europe, the Middle East and Asia.
What we saw when we looked at the data is that it really exploded around 2005, 2004. A lot more companies were finding ways through the Netherlands to avoid taxes. Not all companies are already doing it. Most of them are, but not every company is doing it. So there's still, every year, there's more companies getting to know the same systems and using them, so they also avoid taxes.
And these companies, when they take something over somewhere else, like in Britain or Germany or anywhere, it becomes part of this system.
Yeah. So it becomes part of a larger system that already knows how to avoid taxes.
And some government somewhere gets a little less tax and maybe wonders why.
Yeah.
In a restaurant right opposite the building where Google's profit-shifting company is located, the one with no employees, I met André Nachelmaker from the Association of Dutch Corporate Services Suppliers. He represents the lawyers and bankers who run the Dutch conduit system. Though his members make good livings from the corporate profit-shifting business, surprisingly, Mr. Nachelmaker turned out to disapprove of multinationals using Dutch conduits to cut their tax bills to virtually nothing.
This is the kind of thing we don't want, because that's not within the spirit of the law. We should be able, in a globalized world, to come to one set of definitions that allows companies to organize their international activities in such a way that they are not suffering double taxation, but where they can pay their fair share in international tax.
Because at the moment we're not talking about double taxation, we're not talking about single taxation, we're talking about no taxation, we're talking about effectively stateless, taxless money.
That in some cases that is sad.
It's sad, but it's big business. I mean, we're sitting opposite the building where Google has its key Dutch company. I mean, Google is saving 1.8 billion.
Okay.
Netherlands is getting 3 million.
But what do they bring? How much employment do they bring? How much personal income tax? How much VAT tax do they bring for the world? The fact that information can flow much more efficient from place A to B, how much added value is there in that for the world?
Everybody loves what Google does.
And
all people are saying is Google should pay its taxes. Here it's paying next to nothing because of what's happening up in the building next door, on the 15th floor.
Of course, it is easier to attack Google than to attack international governments. Of course, that's much easier. The question is, however, who is responsible for tax laws? It's not Google that is responsible for tax laws. These are the governments. Who is responsible for international coordination of taxes? It's not Google that is responsible for that. They are a company. It's governments that are responsible for that.
The Dutch government declined our invitation to discuss the Netherlands' role in helping multinationals avoid tax and why they don't stop them using Dutch conduits, because they say they're awaiting the results of a study of the business, due out next month. But with most European countries now struggling to reduce their budget deficits, the EU Commissioner responsible for taxation, Algirdas Šemeta, is pressing for action now.
During the economic crisis, we see this phenomena as growing.
Commissioner Šemeta says European countries between them are losing roughly 150 billion euros a year through corporate tax avoidance. If he's right, that's enough to pay for Britain's National Health Service and the British Army and leave a few billion over in change. To deal with this problem, the Commission has proposed an elegant solution with an inelegant name, the Common Consolidated Corporate Tax Base. Under the CCCTB, each multinational company operating anywhere in Europe would be required to declare a figure for their total profit across the EU. That profit would then be allocated to member countries for taxation according to a formula based on a company's sales, employees, investment and the like. It's a model that's worked well inside the US for decades and made profit shifting between US states a pointless exercise. But for it to happen in Europe, all 27 members of the EU would have to agree. And Commissioner Šemeta says some, including the UK, aren't prepared to do that.
It's true that the United Kingdom in general is rather skeptical about any actions in tax area at the EU level. I have a lot of experience in negotiations on various matters in taxation, and I have the experience where United Kingdom didn't demonstrate solidarity with other member states in tax matters.
And is that a problem for you?
Of course, this is the problem because we need unanimity on any tax issue, and if even one member state disagree with the proposal, then the proposal cannot be adopted.
They were not attracted to that proposal.
At the Treasury, Tax Minister David Gauke.
Clearly, the European Commission wants to strengthen the European Commission's powers in this particular area. We do not believe that essentially handing power to the European Union is a solution to all the issues relating to multinationals and tax avoidance, because that is an international issue. It needs to be dealt with much more at a G8 leading to a G20 level, and this in itself is not a solution to that problem.
So Commissioner Šemeta, he hasn't got a chance. He's not going to get that through.
Well, our position on a common consolidated corporate tax base is very clear. That is essentially having the European Union determine corporate tax policies, and we believe that that should be determined by the UK government answerable to the UK Parliament.
But while Britain is calling for global as opposed to European cooperation to curb avoidance, the Prime Minister is also looking for some way out of the present economic doldrums.
Right now, Britain is in a global race. It is a moment of reckoning for every country. Sink or swim, do or decline.
Motivated by that vision, David Cameron has chosen to set out to entice multinational companies to set up headquarters in Britain. As he said in March,
we are restoring our competitiveness. At the forefront of this is our bold plan to cut corporation tax to 21%. That'll be the lowest in the G7. As the recent KPMG survey shows, in just over 2 years, we've transformed business perceptions of our corporate tax system from one of the least competitive to one of the most competitive in the world.
With decades of experience of the politics, practice and theory of taxing multinationals, Edward Kleinbard says he finds it hard to square David Cameron's calls for their tax avoidance to be curbed with his attempts to attract such companies to Britain.
The way that it can be squared would imply a certain cynicism on Prime Minister Cameron's part, which it's not appropriate for me to ascribe to him since I'm not a close follower of UK politics. But if, in fact, you care deeply about addressing tax avoidance by multinational firms, you cannot simultaneously hold that view and engage in overt tax competition with other countries to attract those very multinationals.
But the Prime Minister is inviting other companies to come in and headquarter in London, so that's going to bring a whole lot more revenue. It's going to bring a whole lot more wages and more tax that way. Isn't that a perfectly acceptable trade-off?
If, in fact, the net result is a larger economy for the United Kingdom, it is an acceptable trade-off. But the strategy fails for two reasons. First, existing UK firms take advantage of those same provisions, and so you lose revenue on that side. And second, like any trade war, other countries follow tit for tat. And you have a race to the bottom in which no one collects the revenue, and the multinational firms laugh all the way to the bank as the countries, in effect, engage in these tax trade wars with each other.
Around the table at the G8 meeting in June, every one of the world leaders will be facing his or her own choice between promoting international action to curb corporate tax avoidance and attracting multinationals to their own countries, with whatever jobs and taxes might come along with them. Treasury Minister David Gauke sees nothing wrong with that.
I make no apology for the fact that we want to have a competitive tax system. We want to have the most competitive tax system in the G20.
Doesn't that mean that that's a tax system where the multinationals are going to be able to go on doing exactly what they're doing now?
Well, our determination is to properly tax the economic activities that occur in the United Kingdom.
That's definitely not happening now, is it?
Well, there is an issue, as I say, with the international architecture, and we're very focused on that. I don't see a contradiction between wanting to ensure that we tax the substance of activity, but also recognising that we do so in a way that is competitive so that businesses actually choose to locate here and bring jobs to the United Kingdom.
For years, economist John Kay has watched governments struggle with the choices and contradictions required to deal with corporate tax avoidance, and he's seen them fail to agree. Now, he says, the consequences of failure could run much deeper than the loss of a few £billion to the exchequer.
I fear when people learn that large companies, which apparently ought to be paying large amounts of tax, in fact aren't. That undermines everyone's sense of the legitimacy of taxation and the tax system. And we just have to look at countries like Greece or Italy to realise quite how damaging it can be when people think that not paying tax is fair game, as it were. So in some ways it was better that people didn't know very much about this.
Corporate tax avoidance is no longer a secret from the public, and governments around the world now face the choice of what, if anything, they're going to do about it.